Over the last 20 years, we've only ever seen this happen 5 times. So what is it and why should we be paying attention? Today we'll do a deep dive together to look for the next market move. And of course, we'll be discussing the opportunities and the cautionary tales right now. More importantly though, is the bonds market starting to fire up on the options side? Let's get into the levels that we really need to be watching together in stocks, commodities, and cryptos today. Join us, this will be a good one. Well, welcome back everybody to the Daily Show where we talk about markets around the world. My name's Tom. We've got a lot to get into, so let's do it straight away. Remember to subscribe and smash that like button if you love markets like we do. It was Nvidia down and the rest of the market basically up as rotation that we've been talking about continued in these markets. It was a mixture of inflation-based trades and also some rate cut expectations on the horizon as we saw solar and clean energy and more importantly gold, regional banks, metals and utilities do really well. It was the old economy really breaking out in comparison to the new economy in communications, technology and semiconductors. Now, is this expected? Absolutely. We've been talking about this rotation now for what seems like well over a month, and it's continued here over the last 5 days. The markets that most people have been looking at have performed very well, while technology and communications remain quite subdued. And this is because Wall Street is most likely doing a little bit of rotational switch. And there are some really good reasons why they might be doing this. Let's look at the first bit of evidence. Now, this is Goldman Sachs top-down model. Basically, it suggests that we are 13% above fair value. Now, you might say, well, who cares? The market trends up. And you're absolutely correct. But did you know that when we are in these types of reads, we tend to actually have a lower return on the horizon? And there are some things that are saying that maybe the market needs what we call a pullback in time or even a corrective move to really get things started for another very nice bullish point. The median forward 6-month S&P 500 returns based on this valuation being so high were actually very poor, only sitting at around 2%, contrarian to many of the other stats that we've seen most people talking about. Now, where could this lie? Well, I think a lot of it has to do with the fact that the options market is implying that pretty much nothing's going to happen. The options market is literally saying that there is a 5 to 6% probability of a 5% up or down move. Now, that's pretty low, and Goldman Sachs thinks it's more like 25% chance of either a really big rip or a decent drop off in markets into the corrective territory being between 5 and 10%. Now, that could happen over the next couple of months, and let's have a look here at why that could be there. The S&P 500 6-month implied vol spread is absolutely in the dirt. So is the Russell 2000 6-month implied vol spread. That is so low, we haven't seen it pretty much in our recorded history. So why is this important to all of us? Well, it's got to do with a little bit of flows and a little bit of the rotation. Now, corporate flows always remain positive, so that's no surprise that it's up here. Retail have started to drop a bit of positioning. Maybe they're smart, maybe they're not. But hedge funds have certainly been dropping quite a lot of positions. And technically it is their job to make sure that they make money that's better than the market. Now you might say straight away, well, they usually underperform. And that could be true. But Goldman Sachs sees that pension funds will be offloading around $32 billion very soon. And of course, we also have a buyback blackout period coming. So could these two big signals show us that markets are starting to weaken? Well, it's ultimately going to come back down to liquidity. And of course, if the Russell 2000 is able to break out, it could be just more of a rotational shift as the market, like the S&P, goes sideways, big tech starts to drop, small caps start to outperform. We will be tracking liquidity later on in today's video, and we have seen some fall off from it, but obviously easing financial conditions and these other things are leading into quite a bullish space. So let's discuss what's going on in this market right now, because obviously it's very, very bullish. On top of that, the RSI has just hit a new extreme, 77.5. Now, while I don't really bring the RSI up too often, there are times and points where you may want to be paying attention to it. Notice what's happened the last 2 times we've hit into these key levels. We've seen an incredible expansion of the markets very quickly. They've had a blow off, and they've led into poorer returns over that next period. Could Goldman Sachs's overall indicator be correct here? The other reads that we got back in 2013 and 2004 led to what we call pullbacks in time. Basically, these are market conditions where it goes sideways for some period and you're wanting to look at single stocks and sectors and rotation through that period. Again, if semiconductors do weaken here and we see strength in things like the Russell, that could also be an opportunity. So we definitely want to be on the cautious side of things right now as these markets rally up. And you might be thinking, let's YOLO, let's get in, everyone's fantastic and everything's good. Yeah, but remember Warren Buffett does have that famous saying, when there's greediness around, you might want to start being a little bit fearful. Let's have a look at the S&P 500 from the shorter date to see whether really anything is looking freaky right now. Well, the close was certainly options trading perfection. Firstly, it closed right on the highs, and that's certainly a bullish thing for markets. It shows that there could be further momentum to come through in the next coming sessions. We also know that it's remained above the daily 20 moving average, which you really should have on your charts, as that's been one of the most bullish signs of this market through this entire rally. And if that gets taken, I think there could be some big flip zones. But it was the 5-minute chart that I want to really talk about. It was a win for the bulls in a big way as option 0 DTEs pushed us towards that call resistance. If you remember rightly, in our last video, we talked about 52.50 being probably the top end for the market. And look where it closed, 52.48, not paying those options out for the 0 DTEs, but getting right near that extreme resistance zone. So will there be a sell-off from this level, or is it going to keep bulling up? Let's look at the bear side right now, where you will really want to be paying attention as a bear. The first level is going to be 51.75 to 51.80. This zone here is not only a demand, but it also has a decent amount of options on it sitting there. If we do get down to this level, I'm sure some buyers will try to buy it. But if we break it, the next level and next stop's 5100, 5090. And if we get underneath that level, we're most likely entering into a corrective period. This trend has been so aggressive that we've never really seen a proper sell-off yet. So if we did get through this, that would be around -4%, and we could be going upwards of about -8% at that point, even into 10. So it will be worth watching the charts for this reason. The 52.50 though is very, very bullish. And what this is showing us is that 52.75 and 5300 are open for the next trading session. Although it is resistance, let's look at the options themselves. And in the future expirations, we can see here that 5300 is one of the most struck zones in all expiration dates. But I'm more interested in the 0 DTEs right now as we're dealing with a very volatile market underneath. There, we could go from a positive gamma to a negative gamma situation fairly quickly, which we need to be on top of. What about the 28th and, of course, next week's options market? Well, first up, you'll notice that 52.50 has now been struck a lot more on the puts, 52.45 in particular, getting a ton. And what this is showing us is that we are trapped within around 52.45 to 52.75, even 52.50, a 5-point increment, where the markets are going to have to probably hedge off the overall 0 DTE. If we start to sell down, 5200 becomes the next level. And if we start to buy up, 52.75 and 5300 are quite good target zones. We're very trapped here with the overall options leading into the core PCE. And as we know, this is an event risk that no one seems to be hedging just yet. But will the Thursday be the hedge? And then what you're wondering here is, when is this happening? Good Friday, just so you guys know. Now, that particular day, we have no markets really trading. Most futures trading markets, I believe, are closed. And we've got Jerome Powell and the core PCE that the Fed uses. So it's surprising that we haven't seen any overall selling or hedging going in. But I think a big part of that was the last 2 days of 0 DTE. So if you've been following along, definitely worth subscribing and constantly looking at these things. Another one is going to be next week on the overall trade days. You can see here that we still are in that positive gamma environment. 5200 struck very well from the put side, and really it's mostly about calls. So again, we remain above 5250. I would expect next market week for us to get to 5300 fairly easily. These are the key levels that we should be looking at, but let's talk rotation now, because I'm really excited for the rotation that might be happening over the next couple of months. And hear me out, because there is so much going on. We already talked about how Goldman Sachs were pretty heavy and overweight, particularly in the energy sector. But there's actually quite a lot of other sectors that have been improving. We've been talking about materials and we've been talking about gold recently, and they've both been doing incredibly well. But did you know that energy sector, materials, industrials, and financials are all absolutely rocketing above their 50-day moving average? And in fact, they're doing way better than the standard info tech and a few other areas. Also, even our little utilities that we're playing into kind of April period, that's been doing really well as well. So there are other opportunities in this market. It doesn't have to just be Nvidia all day. It's all about risk reward. And that's the great thing about trading and investing. There's always new opportunities on the horizon. So what about oil and copper? It might come as a surprise that these have actually been performing pretty well this year. Now, we've been talking about copper quite a lot. In recent weeks, it's broken out and finding a nice little level for itself. And oil, of course, we've been discussing a lot over the last couple of weeks as it's been ripping. But did you know that if we do see interest rate cuts and we're not in a recessionary environment, let's consider that we're actually in a bull market here, that everything is looking pretty good, that gold, copper, and metals are more likely to outperform a lot of other markets. Yes, that's right. Goldman Sachs report here coming in, and it looks pretty good, I've got to say, for plenty of these commodities, which have been beaten down for years and years and years. And it comes back to also looking at these value and mid-cap funds that we've been talking about. The equal weight fund, that is the RSP, is now entered into 17, but it's still well underneath the overall technology funds, which are trading, I think, at around a 28 times multiple. We also know that Russell 1000 value versus growth is really low still. And this could present some decent opportunities on the horizon as we see this rotation go through. Now, what's going to be important to look at? Well, it's that dragon we spoke about the other day, the Russell 2000 breakout, potentially going to happen this week. And we'll be discussing that on the weekend if we see the closure. Forward PE ratios for growth and value. Again, you can see here that it's mostly been all about growth. And that makes sense for the first stage of a new bull market, which we've pretty much gone through at this stage. The second stage generally sees a bit of an uptick in value, although you've got to be very particular about the types of value stocks that you're looking at. Here's a bit of a seasonality trade for DON, which is the Wisdom Tree Value Dividend Fund. And you can see here that during the month of April, it actually has an 80% win rate on standard, and it tends to go into kind of a 3 to 4 month winning period. Now, because it's already broken out, because it's already looking at strength, could DON be actually one of the better areas to be in right now? Well, according to bull market behavior checklists, if we believe this, we're probably in that first couple of stages of bull markets. Therefore, if we are going into a sideways period in markets, which of course we are most correlated to 2012 right now and the 1970s period, it would probably state that things like metals and value funds could do better during this sideways or pullback in time. Now, the RSI is suggesting we're either going to rip super hard or we're going to go sideways for a little period here. And even that rip, if it does go super hard, is going to end in prices coming well back down to around this level or even a little bit lower. So this is certainly a time to be thinking about Wall Street's next move and to be potentially following the price action and the flows. We also know that when we have no pullback for a while, although that is bullish for the markets overall, it does generally ensue in slightly less growth, at least initially. I also found it weird that most of these later on end up going down or sideways in around that 200-day from this point market. That's strange, but we'll look at that. Are we due it? Yeah, of course we're due correction. We're at day 100 and something now. Usually we see a correction at 67 days, but don't preempt it. Price action will be the key. And of course, those S&P 500 levels we looked at before will be most likely some of the best trigger zones. We also know that the bull market has a little bit more to run, at least from the liquidity side of things. And of course, the risk appetite flows are adjusting at this point towards the upside. So things are still looking pretty good on the markets. Here are the secular bull markets. You can see that we're probably around 2/3 of the way through a multi-decade bull market. Here are the rotations that we tend to see and the periods in time that we're at right now. These are the overlays between 1980s and of course the 1950s. We also have the overlays between 74 and 42 here. Again, these are periods where we often do get pullbacks in time, although price action will need to be there. And in some ways, and this is a really interesting concept, are we seeing a change in the expectations of original Dow theory and modern Dow theory? Are semiconductors actually the best indicator of possibly internal weakness? And why are semiconductors currently showing so many signs of weakness overall in terms of price action? Well, a lot of that's got to do with rotation. Remember, there are opportunities on the horizon. Possibly Apple could be one moving forward. You can see here the performance of Apple has been terrible versus the equal weight market. And we do know that CPI year-on-year consensus forecasts are both on the rise from pretty much Bloomberg data and everything else. So the core PCE will matter. What about systematic system traders? Well, of course, NASDAQ CTAs did drop again over the last 24 hours. They've started to drop positions. We'll be the first to alert you if it gets through this low. And we know that CTAs often preempt decent moves. Also, the S&P 500 dropped for the first time in weeks, as we've been on a huge rally here from systematic traders. So both will need to be watched. Let's jump into the charts now and have a look at the caution tails and the good ones going on. And of course, some of the nice trades that we had. First up, the VIX. Well, it's trapped between a Bollinger, and this means that it's coiling within a very, very tight range. Now, a lot of people like Bollinger on the VIX because they look for a breakout of this and a hold, and then they look towards, that really being a big warning sign. The Bollinger being trapped for so long certainly shows complacency, and the VIX has kind of been broken for a while, at least in most people's eyes. As we've already detailed before, really the levels to watch are a 15-16 close, as if we do get back up there again, we're most likely going to need to see a squeeze of people that have been shorting VIX heavily, and it has been suppressed due to those shorts. So they may need to unwind, and it could create an overall squeeze. Central bank liquidity has also dropped in recent weeks, which is strange because, of course, we haven't seen this in a while. It's an early indicator, and it doesn't tend to instantly lead into price, but it is a sign of if we do see a sell-off, it could be more real. Now, there's been a couple of others that we've had in the past, of course, one late last year that ended up starting off here, and we had that famous one that led in for a while and was so early that the market rallied and then dipped straight back down to a well lower level. So we do need to take it with a little bit of a grain of salt, but I like to look at central bank liquidity because if it's dropping out and it's starting to become less supportive, that's important. What about the bonds market? Well, both rebounded. Both high yield rebounded and our own indicator for bonds rebounded. As you can see here, we're still trapped in an overall range. If this market does bounce out though, that's again showing us that we're probably moving into that hyper market where we're going to get a huge blow up. All the stocks will go wild, especially these smaller stocks. And then based on that RSI performance, maybe it goes a little bit bad and there'll be that flash kind of sell. This is another one that we've been tracking, and I can tell you it went up for another day. Now, it made a new higher high, and I'm certainly paying a lot of attention to it. So basically, it tracks here the overall high yield options on bonds, and you can see that it's starting to look a little bit concerning. Now, this has preempted many of the larger falls. Over here in 2024, just before 2023, just before 2024, we saw it rise up, and that led into that January sell-off. So if it keeps rising and the market keeps climbing higher and then it starts to show the price action signs of weakness, certainly one that I will be paying a lot of attention to. And I think all of us should be together. US 2 years still stuck within the range, no breakout to the upside, set alerts for both sides just in case, but we will be watching this. And if the yields end up dropping through the bottom end, that could be extra good as well, as we've seen for things like gold, copper, and many metals traders. Dollar index finds itself as a resistance, and this is a big weekly closure. I'm not going to say much about dollar because we haven't got a breakout yet, but core PCE and the Monday trade may bring that. And the oil market held the level. If you were a bull here and you had the faith, well done to you so far, because oil held, it barely held, but it did hold. And it actually had a pretty nice little day trade on it. We covered it in our Market Masters Club if you're ever interested. Free 7-day trial on our website, fxevolution.com. But this particular one had some decent structure on it. You can see here the daily closure was actually quite nice. Now, the weekly will be all important to oil because oil did show signs of weakness last week with this huge rejection week and what many people call a shooting star or pin bar candle. Oil traders do not want a new low here. If that happens, back down to 78 we go. So for now, the weekly closure will be important for oil, and hopefully it's able to continue its bullish momentum. Another thing is the movement in rotation. Semiconductors versus the S&P 500. What's going on here? Well, it's weak, and it makes sense. It's been absolutely outperforming for a while, and it's pretty normal. We get these huge rotations into semis. Everyone gets hyped. It becomes a little bit of a FOMO kind of field, and we go into a pullback in time or even a little bit of a pullback. Now, we saw the topping of this a few weeks ago, and we already reported on it back in early March, and it's continued here to be a little bit of a weak or kind of poor market. And that's just showing again that everyone's talking about semis. I believe in them long term. Of course, if you're an investor, I would say semis are the best sector in the market to be in. They always have been for the last decade. and they continue to probably be so. But they've come down and put pressure again on this daily 20 moving average. And if they break down below here and the market keeps driving higher, that means it's all small caps and the old economy. And then if they start to drop off for whatever reason, yeah, you're probably looking at a correction at that point. One to track for everybody out there. Now, we talked about DON before, Wisdom Tree Midcap Dividend Funds. You can see here that most of these dividend funds, most of these mid-cap values continue to rise up. And there's no reason to say these are weak yet. In fact, there's a flag pattern. You would say that there's even more potential for these to move up. You could take this distance and say, look at this thing from a breakout perspective. It could go all the way to 52. So there's a lot of action going on in the mid caps right now. They continue to make a series of higher highs and higher lows. And really, it looks a lot better than the semiconductor market. And it has done so since pretty much the mid of February. And it's really been that robust kind of bull move that's seen there. What about some of the most hated sectors? Solar, clean energy. Are they starting to perform? One of the ways you can track this is by looking at solar versus the SPY, or even looking at solar versus the RSP or the equal weight. So one of my favorites is to do it versus the RSP to see whether solar is actually tracking or whether it's bottomed off. Now, you'll notice there's times where solar does well and times when it does terribly. But as a comparison versus the RSP, it's near all-time lows, and it's actually back to where it was in March of 2020. So solar markets are terrible right now. Have they bottomed? What's your thoughts? Comments down below. Let us know, guys. This seems to be a bit of a value zone where somebody at least is trying to pick them up. Another one's been metals versus the S&P 500. You can see here metals look like they're having a really good base off, and they've been outperforming in recent weeks, just like energy has and many other sectors. So it looks like the old economy is coming in off the expectations actually of rate cuts and a non-recessionary market. Now, if we go into a recession, of course, that's not going to be all good. And how will you track a recession? Don't ever forget US 02Y versus US 10Y, or the 3-month versus the 10Y. These are two that you really want to have on your charts. And if it goes below 1%, that's when you start having cautionary tales. Generally, it's very early. So really, it's when you go back through this, we're still somewhere around 6 to 12 months before something really goes wrong. But yeah, you want to track this one for sure. Let's now also go through a couple of other things. You can see here copper stocks have already been rotating for a little while and moving up, and that's been looking quite good. And the US 2K is one that I really want to discuss because this week matters. We've already got the high being put in here at 21.20, and if this weekly closes at these highs, that's a very bullish sign for the Russell 2K. So it's kind of showing that we could move up aggressively, and all the small caps will be the ones driving it. So small caps will be big, and we're looking actually at things like the 2250 for Russell. So there's really nothing on the left-hand side stopping it from being able to have a nice rotation. We will cover this if it happens, and I want to cover it. I'm looking forward to it. Tesla held barely. It's still doing okay. The wick was obviously bullish. We haven't broken above 184.50. We obviously got the 181 kind of 70 zone the other day, which was again bullish looking. Could it be a run into earnings, which is only a few weeks away now? I would say that it may be an optimistic run into earnings. It is something that we, of course, are watching on these charts and will continue to pay attention to them. Another one that's been doing really well is something we've focused on in our live shows and we've talked about, which is PayPal. Still struggling around that 68, but if it manages to get above this high, we're looking towards 75. So again, just smaller stocks starting to improve. Utilities also had an amazing session, 2.79%. Yeah, that's nice. Considering it's utilities, that's really sweet. So congratulations to people that have been interested in that particular sector and following along on some of our rotational thoughts. Let's move now to a few other markets. I want to talk AMD for a second here because, of course, AMD has famously entered into a technical bear market, although it's finding some buying pressure. And in the last session, it went back up to 179. Now, Intel actually did better, even though they've both had bad news coming out. But a nice base here, and hopefully it can hold for the week, really solidifying that this might be as low as we get for AMD for now, and maybe the bulls will start to pick it back up. NASDAQ remains kind of dull, not great. Could it be a Wyckoff? We do have that potential UT or UTAD style false break. We don't know yet. We'd have to actually see it sell off. We're watching. The trend is up for now, though. I wouldn't go against this market, in my opinion anyway. It could just be rotation. Bitcoin, now it got through the 70. It had some excellent trades down here and here. Particularly this one was really sweet. And now we've got two long leg dojis. Now the charts are suggesting the bulls are in control. Small time frame traders will say, but Tom, the bears. And I can understand why, but I think the trend is generally bullish here. So just be very careful with Bitcoin. You can see it's bouncing off one of our little supports, another one around 67 for the buyers if they try to pick it up. But if it gets back down to this 63 where I've got bulls need to hold, I don't think it's holding that level. I think it would go lower, under 60, then down to possibly the 52,000 range. Now, we talked about the news before, so let's have a look here. Do remember that Friday is going to be a bank holiday, most of the places around the world. And we've got here core PCE and the Fed Chair Powell speaking. So this is technically a risk event. We're at resistance here on the S&P 500. If we take 5250 early, though, it's more than likely the market will try to hedge off, moving towards 5275 and possibly 5300 for the weekend. And then we'll find out whether volatility really comes in. Look forward to it. I look forward to going through this stuff on the weekends. Maybe the Russell and the Sleeping Dragon are finally here. But one thing's for sure is Wall Street's rotating and most people are missing out. Good luck, guys. Bye for now.